Yeah.
Friend stepping up in it.
All right, we are live,
Right
and
on.
Finish my lunch on air here.
there you go. I'd
Nice.
say
I don't know why you wouldn't.
per tradition. So, Sue, you're down in Florida, and Bill, you're in the home office,
Yeah, I'm in New Jersey. Yeah.
Jersey. Yeah, you still a Sixers fan?
Yeah.
Yeah, it's like it's the same way I answer when anybody asks me if I'm
It's a real delay. Yeah, I'm
still a
still
Browns
trying.
fan. I'm like, yeah, you know what? God damn it, I am still a Browns
They
fan.
could still hurt you. Yeah, they still
Yeah,
hurt.
so,
So
but
don't you aren't you supposed to go to Minnesota in the summer?
Tomorrow, yeah, we are waiting. I am deep in the midst of a mortgage process, which is giving me renewed empathy for what you go through. So yeah, it's our new construction right outside of Minnesota, actually, Hudson, Wisconsin, and it was supposed to close in March, and here we are. So, yep, taking off tomorrow, heading back up north, and we'll see how it goes.
you want to throw your lender under the bus on live air
Do
here?
not, because it is my brother, and it's actually not his fault. It's the
Steve.
it's the I know it's good old Steve. But it's the new construction. Anybody who's been through it or lent on new construction, you know the drill. It's like it's March, it's April, it's May, it's June, it's July now. So we're hoping it's done next week.
You know,
So
I was out
Hudson
there.
is awesome, by the way. Hudson's a blast. So please come on over and see me.
Sue, I was out there a couple times speaking at the state MBA, and it was beautiful. And I didn't realize, like, of the top 100 golf courses, like a dozen are in Wisconsin. And, I remember the gentleman that played with us. He joked. He said, "We're getting here early." This was about a month or so ago, before the mosquitoes come out. Because Mike Hall, great guy from RHMI, he said the mosquitoes might be the state bird.
Yeah, it's about right. But
Really
for
good.
anybody wondering, though, I am not becoming a Packer fan. That's where I
Okay,
draw
so
the line.
just
Draw the
across the
line.
border into Wisconsin, but your loyalties, Ant-Man, and I guess you got
Absolutely.
JJ McCarthy this year with the Vikings. So
I think we're looking good. I think we're looking good. School sister. That's right. So it's all
cool.
good.
All right, well, let's go ahead and get into it. This is The Big Picture, presented and sponsored by our great friends at Depth, founded by industry vet Carrie Milam. Depth, a full-service PR and marketing firm working inside the mortgage space, the fintech space, working with growth phase innovators to just level up their visibility and achieve their strategic goals at the end of the day. So they focus exclusively on those arenas, and just great resources and just impressive professionals with our friends at Depth. So if you are a company that needs your story told better, and I would argue about 93% in the mortgage industry do a horrible job at it, get with Rob or I, and we'll get you connected with Carrie and the crew at Depth. Rob, your hand is up already.
I've got multiple things already to talk to you about, Rich.
Oh boy.
So Skoll is a Scandinavian cheers. You know, congratulations, hats off to you, you know, kudos kind of thing. Skoll.
School.
I believe the chewing tobacco took its name from that. So the second thing is every time you talk about depth, and I'm a big fan of Depth, but the way you talk about it, I flash back to, and this guy's on YouTube. It's the homeless guy with the radio voice.
Oh boy.
Did you ever see that? Have you ever looked at that?
I'll look him up now.
Oh my God.
I've seen
Oh my
that.
God.
I have seen him. He's got a big head of hair too.
Yeah. And like the driver pulls up, and this guy's, you know, has got a sign out there and a sleeping bag and a golf shopping cart or whatever. And he runs over to the car, and he like, what comes out of his mouth is like flipping, like, holy smokes. So, you know, those of you viewing at home, go to YouTube, type in like homeless guy with radio voice, and you won't regret it. You won't regret
Pretty
it.
cool.
So
I get that a lot, the radio voice thing. That's actually what I wanted to be when I was younger, is I wanted to be a sports announcer. And then I realized, you know, all the ex-athletes get the jobs, and, you know, there's like, you know, if you're announcing like Eastern Michigan basketball, you're making like 34,000 a year, you know? So it's, I had to, if that, yeah. So I had to pivot,
Have
but
you ever done radio? Have you ever done it?
yeah, I ran the most popular. I started, ran, and sold the most popular Cleveland sports website for like 10 years and sold it to Fox Sports like 10 years ago. So we used to do all kinds of art. We were partnered with Sports Time Ohio, which is the used to be the Indians like cable station. So we would do a lot of stuff with them. So,
So Rich has been living off the interest from the sale proceeds
no,
for the last 10
Can only
years.
imagine.
it wasn't a lot of money. And, after 10 years of building it up, but that's usually how those things work, isn't it? Right?
You're in this for the love, not the money. So,
Yeah, I've been doing this commentary thing for 15 years. I'll tell you, I'm like one good scratcher away from retiring. One good lottery, one $1,000
I'm
lottery
still trying to
ticket.
aspire to your life, honestly. I don't know why you'd want to retire from that. It's like, you write a
It's
commentary that everybody loves and, come on shows, get to talk about the mortgage industry, but maybe it's over, maybe it seems better than it really is.
yeah, yeah, it's a drag.
you're just back from Hawaii. You can't even say it's like, I mean,
Oh,
you
let's not
travel in
talk
good
about our
circles.
travels, Sue.
All right. Okay. All right. Fair.
Yeah,
This is a
Dave,
heavy traveling crew on this.
Kyrie,
We.
Bill was probably just in, Cleveland or something, or
Not yet.
Moose Falls,
We're on a quiet.
Montana.
We're on a quiet. I'm actually headed out to speak at the West Texas MBA in a couple of weeks. We're in that quiet spot. So there and then Colorado, but picking up in a few weeks. So I'm
You've been
enjoying,
a crazy
enjoying
road warrior.
Oh yeah. Yeah. I'm really going wild the last few months.
Yeah,
Love it.
I
Been
know.
fun.
I see it.
Been fun though.
It's
All right,
good.
cool. Let's go ahead and get into it. I'm Rich Swerbinsky with Onward and Upward Consulting, as always, joined by my esteemed colleague and co-host, Rob Krisman. Rob, great to see you. Happy Thursday.
Happy Thursday.
And this week, really, really pleased. We wanted to do something fun this week. These are two former guests that we've had on the show, and we'll continue to have on. And they work together, right? I mean, how long did you guys work together at
Oh
Vantage?
my God. Like 17 years or something.
Yeah.
I mean,
Yeah.
freaking
I remember,
crazy.
yeah, because I
Yeah.
remember like when I was a young, a young punk in the industry. I just remember like the two of you and like seeing your names around and yeah, just thinking you guys were cool industry leaders and you've
Still are.
yeah, still
Still
yeah,
cool. I don't
yeah,
know
I
about
guess I
leaders,
should.
but we're cool. Just old.
But
Well, Bill, we had a great time, and we did a lot of travel together. And so the great thing about Bill is he is the most quick on his feet, funniest person I have ever hung out with in my life. I mean, he's just like always got the lines, always got the lines. But what I did learn about Bill is he's got to eat at very regular intervals, or he's one of those hangry guys. It's like I would like want to travel with like a little Snickers up my sleeve or something to give to him because whoo, the fun was all over if he
Uh,
wasn't getting a solid meal pretty regularly.
well, I was big. I was a little bigger then too. I mean, I remember going on a trip. And by the way, it was out your way, Rob. Years ago, I was at Del Rey. I'm sorry, I was up in Monterey, and we're staying at a beautiful hotel. And there was an opportunity. We're speaking the next day at Fresno. I didn't know what Fresno was, so we gave up this beautiful presidential suite to drive over to Fresno. I didn't know Fresno was Fresno, and I remember getting on a scale then, and it said 200 pounds, and I damn near had a heart attack. And for those that watch the bond market, we talk about resistance and support. I didn't go one tick above that. I mean, I hit 200. I haven't looked that way since, but yeah, back then, if I missed a meal, that was crazy.
Fresno, I remember that.
and we haven't even properly introduced our guests, but they are Sue Woodard, the Chief Customer Officer for Ingenious and Senior Advisor for the Stratmore Group. Sue, great to see you as always, and looking forward to the conversation.
It is great to be here. Thank you.
And Bill Bodnar, the Chief Revenue Officer for Tabrasa. Bill, great to always see you and looking forward to the conversation today.
Thanks for inviting me, my friend.
All right. And as always, Rob, the headlines failing to disappoint. Just, it's so much to go through every week. I keep harkening back to last year when there was like no news for like 9 months straight. And it's been quite the opposite this year. But the biggest news this week of the regular menu is the VantageScore thing. So Bill Pulte comes out and basically announces on Twitter that, hey, VantageScore, bring it on. We're going forward with this, and which of course then set off a flurry of industry, tizzy people, calling their credit providers, trying to get their prices reduced, and obviously this is a huge change for the industry. It's going to take some time to flush itself through. But Rob, your thoughts when you heard that news break this week?
Well, it's so funny that you say obviously it's going to take some time. Uh, and Bill Pulte said it was effective immediately. And the my commentary the next day, I asked the question, is basically is the privatization of Fannie Mae and Freddie Mac going to be handled in such a cavalier fashion as this? Because he just with a few sentences, suddenly the industry is thrown into, as you said, you use the word tizzy, and it's true. The fact of the matter is, obviously, these things take time. Obviously, you just can't wave your wand and change the credit structure of the United States mortgage industry, or I should say, agency-related mortgage industry. And so I would say it's an example. Bill Pulte were sitting here next to me, and I think Robbie's supposed to interview him at some point.
Oh, really?
But the I would say, you just can't wave your wand, Bill, and do these things. And I don't know, maybe you're taking after your boss to some extent with regard to tweeting things out and expecting them to change. But this is a major thing that basically caught Fannie Mae and Freddie Mac flat-footed, as well as the credit reporting agencies, as well as FICO and so forth. And I think it's important for people to remember when you talk about VantageScore, correct me if I'm wrong, Rich, you probably know. I believe the three credit companies own VantageScore,
You do.
right? TransUnion, Experian, and oh my gosh,
TransUnion
The third
Experience.
one.
who's the third one?
My God, I'm drawing a
Your
blank.
marketers would be so upset right now.
Equifax. There we
Oh
go.
God, thanks
There we go.
everybody.
Gemma, thank you, Gemma.
There we go. Oh my gosh.
Touche for Gemma.
Well, so
Allison,
anyway, I'm becoming addled in my
Bernard.
old age.
idiot.
So anyway, so they own Vantage, and so they've got a dog in this hunt, and obviously they've caught the ear of Bill and the gang, and so. But I think the industry, I think the goal is right, but I think that it's going to take quite a while. It's going to take quite a while, and there's so many questions, and I raised them in my commentary that need to be answered by the GSEs. And if you're looking to Fannie Mae and Freddie Mac for answers, they don't have them because they were as surprised as everybody else by this announcement. So it's a good thing that things are kind of slow right now in the mortgage world, but it's going to take a while to implement the changes that he thinks could be implemented effective immediately.
Rob,
So,
when you say a while, what does that mean? I was surprised. I'm glad I wasn't long Fair Isaac when it took place. But what does it mean that it's going to take time? Like, I like the idea when I read it, and because I was surprised like everybody, and I read the details, and I like the idea that, where it's headed and more competition. That makes sense to me. And I could definitely understand the midst of the chaos that's created by just throwing out a policy. Hey, we're going to start this thing up tomorrow. But it sounds like a good outcome. And when you say a long time, what does that mean? How long?
well, a good outcome. I mean, that's what I said. The goal, the end result will be good. I know that the National Association of Realtors latched on to the fact that, wow, rental income will now be, included. So that's a good thing, right? But the question is, how do you include rental income? What kind of rental income do you actually include? Do the agencies have the personnel? I mean, they've been through some layoffs. Uh, I remember several months ago, I think Bill, and I forget, I should have looked this up ahead of the show, but I remember Fair Isaac stock plunged at some point because of an announcement that Pulte made. So now you've got a situation where how do you include that rental income? And NAR came out with a big thing. Oh, rental income will now be included in analyzing borrowers' credits. Well, how? That's just it, Bill. How, Bill Bodnar?
Yeah.
How is that going to happen? And do the agencies, first of all, like I said, it caught them by surprise, but it's like, oh, oh, all right, now what do we do? Now, the director of the FHA has come out and said this. So now how do we have to react to it, and we have to give our clients answers. And frankly, what the capital markets group that I correspond with all the time, they have not heard anything concrete from the agencies. And then once the agencies come out with a policy and procedure, then the big aggregators will have to do the same. And
Yeah.
meanwhile, the whole non-QM segment of the industry is watching this with great curiosity. And I'm continuing to see loan officers direct business to non-agency outlets such as non-QM because it's just easier. You don't have this turmoil. It's just like, all right, these are our guidelines and they haven't changed yet. So let's just, wave in the business. So it's
Hmm.
thrown the industry into I won't say a tailspin, but there's confusion out there. And you know, you guys, I mean, the four of us probably have a combined, you know, 100 years in this industry. And so you realize things take time. I think
Oh,
viewers
yeah.
in this show, over the show, realize you just can't wave your wand and expect something to happen. And like going back to the issue I raised in my commentary, everybody's hoping that Bill Pulte doesn't one night say, "Hey, tomorrow we're going to release Fannie Mae and Freddie Mac from conservatorship. Best of luck." These things need to be thought out in a
Yeah.
in a careful manner.
The thing that I will say though is I do things have taken so long to enact in the mortgage industry. And usually the end result of it goes through all the gyrations and all the committees and all the things is usually suboptimal. And so I wonder, if the strategy is, and I'm not saying this is the right way to do things, but throwing a little grenade on the table to, because the ultimate idea is to create more options for more borrowers. Susan brought up a really great point about that most lenders are going to be pulling both scores and picking out what's most advantageous for their borrower, right? Meaning
That
additional
costs more.
cost. But
Absolutely.
at the same time, I think I feel a little ready for some things to happen a little faster to try to help the people that need help right now. And so I'm not saying dropping a grenade into the middle of it and hoping it all works out is always the best strategy. But I think we also, in our 100 years of combined experience, have seen a lot of issues where it takes a lifetime. And then by the time it comes out the end, the moment is lost. The point that they were trying to help on is no longer helping. It's just, it that's tiresome to me as well.
Well, so Sue, given what you talked about running this score, score, throwing out whatever, will that help the cost of a loan?
Ultimately, if they're able to get a better deal because they've got both, I mean, yes, is it going to cost X amount more if you're pulling both to see if somebody, is going to qualify for something different? But I think looking at the, overall life of the loan, if there's more advantageous offerings that are available with that, yeah, I would say that it would benefit the consumer.
Yeah. Over time, yes, I agree with that comment. I question though, if I'm a loan officer, I want to qualify that borrower, give me a choice of a dozen credit methodologies. I'm going to run all 12 because headquarters is paying for the cost of these credit reports, right?
Well,
And
yeah.
then it goes back to, an argument was been raised in recent years. Why not have the borrowers pay up front to run the credit report rather than have the lender pay and then charge the borrower when the loan funds? Why not have the borrower pay up front? And then you have loan officers saying, well, we're going to lose our clients if you
Yeah.
make us charge our borrowers up front, you
Yeah.
know?
Everybody'd have to agree to do it at the same time, which I hear we don't like to do in this
Hmm.
industry.
No, no.
But it's a great point.
Yeah, we'll see how it all plays out. Ultimately, yeah, it's going to be a good thing, and you're not going to have to run two scores on everybody. I mean, I think I heard a stat like Fannie and Freddie, like 70% of their business is over 740 FICO, right? I mean, no matter what score you're running, if they're 750 plus on the FICO scale or 740 plus, that's the only one you're going to run. And then more importantly, it's just, I mean, FICO's prices have just kept going up and up and up. Everybody's got to use it. I'm kind of with Sue here. Like, this isn't that huge of a change. I know it's going to take a while. It's just another score that's already established. And yeah, you're going to have to figure out some logistics. The aggregators are going to take longer after Fannie and Freddie put official policy out there, but it does kind of force action, and I just watched the old FHFA. I watched Sandra Thompson came to our conferences at TMC like 3 or 4 in a row, just round table after round table with our members about like this issue. I'm just like, my God, allow another score already. So I do like that. We'll see how it all plays out, but yeah, certainly the talk of the industry this week.
I want to know how Rich and Sue managed to type notes while we are on camera here without like moving their shoulders or just like, their fingers creep up over the key. How does that work? How do you guys do that? Is that a class somewhere at some?
Accomplished, yeah, multitasking,
Oh,
three
Rob,
in
great,
one.
great, great minds think alike, Rob. That's
Yeah, clearly. I mean, I can barely get out my commentary without people watching me, much less you guys typing, intricate notes to people while we're watching. It's like a magician. Yeah.
we're going to bring in a visual aid at this point. And I don't know if you guys can see this on the Zoom, but I'm going to pivot to Bill now.
Sure.
Bill sent me over this incredibly,
Simple chart.
simple looking chart. And Bill, the bond market, it's what a year it's been. We got a little relief like around, leading into the election and then after the election, and then, the tariff talk and the tariff news and all the gyrations of the last several months. It feels like now that's all kind of flushed itself through, and stocks and everything else back to kind of where they should be independent of that. But where would the state of the mortgage bond market right now? We're at about what, 6.8 on a 30-year
Yeah.
fixed rate now. What are the key bond market signals you're watching right now? And more importantly, how should the originators watching or listening to this call be looking at them and thinking about them right now?
Yeah.
And what do the yellow lines mean?
The yellow lines, exactly. So, as we know, no one knows what rates are going to do, but you can read the tea leaves. They're definitely in the last 8 months just to show what we have here. This is mortgage-backed security pricing. So as prices go lower, rates go higher. As prices go higher, rates go lower. And you can see from October through today, we're in this band, and it's about, call it 150 basis points or so. And we're living in there outside of a couple little blips here and there. And you could see recently, just the last week, when the 10-year note hit 418, we kind of opened up above it and moved lower. It was a classic reversal signal. So there are a lot of people out there to talk about where rates are going. You're going to know exactly what to tell your clients when we break out of this range. Like if we break out to the upside, everybody could say what's going to happen, what if this happens, maybe. If we go above that, let's call it, par on that 5.5% coupon, convincingly, we're going to go to the left side of the chart and revisit the price highs of last year. Now, on the other side of the universe, if it would be a really bad thing if we go beneath that 98.50, go the other way, then we're going to be starting to sniff towards that 7+ mortgage again. So what I tried to articulate here, Rich, is something simple for the loan officers to think about. This is the range. Just show it to your clients. This is our world. It's been sideways, volatile, and that 150 basis points equals about call it a quarter to 3/8 in rate. So when I do say like there are better times to lock and float over the last 9 months, there certainly has been. And so I would be using this chart and share it with the partners too, because partners think, hey, if the Fed cuts rates or mortgage rates going lower, well, that didn't work out too well last fall. So
in the next big numbers that we have coming out, we get what, CPI and PPI? Is that next week?
Well, it's interesting. We have CPI next week, which is big, but the one that's really interesting, and I heard something about this yesterday, market calendar, July 30th. July 30th, we're going to have the Fed meeting. Of course, the Fed's not going to do anything. And by the way, there's really no chance of a Fed rate cut. It's not even penciled in for September. We're at 65%.
I haven't looked, Bill, at like the CME Fed Watch. Like, what's the percentage chance of July? Is it?
Oh, it's nothing. It's like 3. It's 0. It's like it's gone. That ship sailed. So it's like 95% they sit. And believe it or not, even in September, it's about a 65% chance of a cut. So there's still a good third. So if the numbers get weird. But what's also going to happen on that day, and I've heard this now a couple of times, and I got to dig into the details. On the 30th of July, now this is the same day as the Fed. We can talk about shadow Fed and all these other things. the Treasury is going to make an announcement as to their refunding, what type of debt they're going to sell. And there's speculation that they may come out and say, you know what, we're not going to sell any long-term debt. And that can cause a real wild move in the bond market, because there's a saying, bonds hate more bonds, right? As mortgage professionals, we have to watch those long-term auctions, 10-year notes, 30-year bonds. If those suck, rates can't get any better. And the opposite is true. So the idea is if we start selling less long-term debt, that will be good for bonds. And that's going to happen on the 30th. So we're going to have the Fed and the Treasury announcement. That's a few weeks. That's going to be a big day for us.
Interesting. Pivoting to Sue, the customer, you spent your whole life, Sue, really on the customer side of the business, and you always have the coolest title, Sue. You weren't you? You were like the chief evangelist or something, I want to say, at your last job. That's a great title.
We made that up.
You
So,
made that
you know,
like
but
chief customer officer. I feel like I hear that more now, that title. But
it's,
I do
you know,
like
I had to ask when I first held that title of total expert, I had to ask if they made it up, you know, because I'm like, that sounds just like too cool. But yeah, it's definitely a thing in technology companies. And so, and it's been a title I'm honored to have. So
I
yeah,
love it.
it's good
And
stuff. But yeah, a lot of time with customers.
with all this advancement that we're seeing, it's been wild this past year with generative
Mhm.
AI and just
Ooh.
automation. And I would love to just your thoughts on like the human touch, like part of sales and mortgage. Like what parts of that get more important, in this kind of new world, and conversely, what does it kind of eat away at?
You know, I think actually I'm weirdly, and I might not have said this, I don't know, not too many years ago, but I'm weirdly excited about the agentic AI because I've heard it and it is so good. At least some of them are so good. I heard Betsy at a Lending Tree conference, Total Expert has an agentic AI. They're coming out of, I mean, I think it's being more broadly released now, but it's the recordings that I've heard are so good that the customers that they're talking to and prospects that they're talking to, they have no idea that they're talking not to a human. In fact, 3 of the agentic AI agents have been asked out on dates, and that's how good they are, right? And it's remarkable when you hear it, and so it makes me kind of rethink. I mean, the idea is that you think about these agentic AI, and this is one of those things I feel like lenders are missing the boat if they do not at least check this out. They're able to, they're not taking time off. They're able to work 24/7. There's no managerial issues. There was one prospect I heard, he kept calling the AI agent young lady. He's like, well, listen here, young lady, listen, young lady. I'm telling you, young lady. And I thought, there's a loan officer who might have gotten offended by that or changed their, kind of maybe their approach. The AI agent just blew right through it, raising objections, blew right through them. And then next call, next call, next call, next call. And the idea is, again, it is getting transferred off to the human at the right time, right? To provide that advice. But when you think about the power of being able to, for inbound and outbound, I would have never thought. I mean, I've always been a fan of technology supporting the human in that customer experience. But I think the way, it's like when you read a lot of the data right now about what consumers are looking for, what customers expect, they care more about competency, understanding competency, transparency, understanding what's going on than they do about, likability of a loan officer. Now, I will contend, I still don't think anything, I'm going through a mortgage right now, right? And I've been through how many mortgages in my lifetime, personally, but I do want to have, there's a lot of it I'm happy to do online, great digital system. I'm happy to, talk to whatever. But when the point comes, there's a few points when you're making decisions about, kind of product structure, when to lock, getting the kind of information that, Chabroxa clients are able to get through Mortgage Market Guide. Those are the things where you do want to talk to a human. And I'm no exception to that. I've been through this a dozen times, but I want to reach out my hand at those right times. The other piece where a lot of lenders, I think, kind of miss the boat is after the closing. They tend to, Mike Seminari of Stratmore just wrote a great piece on this where he talks about how we tend to pull people right after closing when they're still on a high. Yay, everything's great. I got my keys. We're moving in. It's exciting. Okay, yeah, I remember that loan officer that I was working with. And it's later. Servicing transfer is a huge friction point for people. And usually that's when there's no one involved, human or otherwise, to kind of tie back. So they say that, again, those particular juncture points, the advice, the structure, making that decision to lock in, and then post closing are really key times that it's really nice to have that human touch. But me personally, I love if it's teed up to me by technology, by AI, and it sends it over to me, say, hey, call this person right now. That's the magic. I mean, AI can work 24/7. I can't. It's gonna, I want to harness it, not run away from it.
So Sue, what you said something that was a little bit puzzling there when you talk about AI or the system queuing something up for you, i.e. the loan officer, why
Yeah.
doesn't it just if it's capable of making a human voice and not the other person on the line not realizing that they're talking to a machine, why even queue it up?
I think on the application part of it, and I don't know all the legalities around it, but I don't believe like they can actually take an application. I think they can take the information, but I think ultimately my understanding is the way that most of them work is they're pre-qualing, they're doing this, they're doing the follow-up. I've seen calls say, hey, disconnect, I got somebody at the door, it'll call back. But eventually my understanding is it has to get transferred over to a human with an NMLS number.
Rob, we saw like Microsoft just shed like 9,000 jobs. I think most of them are in sales, which seems kind of counterintuitive. Why are we getting rid of salespeople? It's because of this. And to your point, they're not taking a loan application, but they're going to be driving a lot of sales activity. So I see that agentic AI really doing amazing
It's crazy.
stuff. It's just, I remember when you and I we were in Securin a couple of years ago, we spoke 2 years ago almost, and AI was like, here, it was this big. And we were talking about, yeah, it's going to be great for marketing. 2 years later, it's like, mind blowing. I can't even imagine where it's going to be 2 years from now.
And I think it's the magic is, yeah.
Oh, go ahead, Sue.
I was just going to say the magic is also the data, right? Because I mean, I think there is a world of data out there that I think lenders by and large I see don't do a great job of capitalizing on and finding where are the opportunities, where's the life events, how do you find those things out? And I think being able to utilize data plus some automation, getting something warmed up and then sending it to a loan officer. I mean, I think that's a pretty great recipe for success.
So you don't see the industry returning to taking a loan app on a yellow pad of paper coming back anytime soon?
I don't know. I loved my yellow pad of paper, man. I mean, I did, but I don't think we're going there.
This is the big picture presented and sponsored by our friends at Depth. 20 years of so ably serving the mortgage and fintech markets for public relations and strategic communication needs. DepthPR.com for anybody that wants to learn more or just connect with Rob and I. We'll get you connected with their president, Carrie Milam. So
yeah, not only, I mean, I don't think their focus, I mean, their focus could be that, but Depth also handles other industry public relations as well and marketing. So that's cool. It's good to have a diversified portfolio.
Diversified portfolio. It's not all water stocks. Which I'm probably are performing well right now, Rob, would be my
that's an inside joke, but for the folks who don't know. So yeah, I've told Rich a number of times that my entire 401k is in water related stocks because when push comes to shove, I'd rather have a gallon of fresh water than, the latest iPhone.
Yeah.
So that's where I put my money is in clean water. There's Sue having some clean water right there.
You inspired me. So
Sue, you're not helping the trade imbalance.
I'm sorry. I'm not.
No.
I'm sorry. I like Pellegrino.
Bill, back to the bond market.
Yeah.
Any potential catalysts may be out there this summer and fall? The spread between the 10-year, the 30-year fixed rate still wider than it historically has been. SLR, a lot of us paying attention to that. If that regulation could get changed, could be big for rates just in the short and long term. Anything else? I don't see this Fed buying mortgage-backed security. I can't see them doing that as a way to maybe help move the needle. But yeah, just your thoughts on any maybe catalysts we could see.
I guess for listeners, you talk about the spread between, let's just say, mortgages and the 10-year note had gotten up to 300 basis points. Maybe it's somewhere like 240 to 250 now, historically, pre-pandemic, maybe sub 1.5 to 2%. I don't know that we're getting pre-pandemic anytime soon, Rich and Rob. I mean, I'd love to hear your thoughts, but a couple things are going to happen. The Fed has said, and some of these shadow Fed candidates like Warsh, there's zero appetite to be buying bonds.
Do you have a shadow Fed candidate favorite, Bill? Is there odds on this yet? Can I bet on this?
I don't know. Oh, I'm sure. I have to look at Polymarket. Maybe somebody on the thread has it. But, one of the, so the Fed's not going to buy it. The Fed, remember, the problem that we had is when we were wrong on inflation, we said it's transitory. We got to stop buying bonds. We got to stop buying them quick, all that crap. There's really no appetite for mortgage bonds. So with the Fed not being a buyer, the spreads widened. And until there's real clarity on inflation, the direction of the economy, I think that the SLR is the wild card. And I think that's going to happen. And for everybody listening, that essentially this enhanced supplement leverage ratio will allow, like, let's call them like the 8 globally important systemic banks, or I forgot the term, but you think of like JP Morgan Chase and some of the large ones, they have about $12 trillion in assets. And if you move that needle just a little bit to allow them to buy treasuries, I think that could help certainly with the spread and certainly add some liquidity to the market. So that could be a good thing. I think that's coming. And then, of course, we got this event on the 30th, which, with the Fed, with the Trump and Pulte and everybody really kind of ganging up on Powell in an effort to kind of drop rates. And by the way, what's really funny about the Fed, just talk about the Fed for a minute. I don't even think a Fed rate cut even helps us in the mortgage business. I think it helps a lot of other people for a lot of reasons. Certainly helps us lower our interest expense. So we got to be careful what we wish for. But they may institute some of these changes like the ELSLR, the less bonds, and those could surprise us with lower long-term rates. We'll see. I like that Scott Bessent is just focused on that. And there's limited tools that we have when we have 37 trillion in debt and programs coming out the wazoo. We got to grow the country. We got to grow the economy, and we have to get to a spot where we really, really stop spending.
And the spread between the 10-year and mortgage bonds, like for the layperson, because it is confusing. It's like you can buy a treasury, like the average life of a mortgage in America is what, like 7-8 years.
That's kind of what you think about it. Yeah.
A lot of us will watch the 5 and 10-year treasury because it's an accurate, kind of predictor of mortgage rates. And typically there's been 150 to 200 basis point spread to buy mortgage-backed security, essentially at the same coupon as a treasury, which is risk-free, very liquid. Obviously, with mortgage-backed securities, you have prepayment risk, you have default risk, other risks, and the market has historically paid up. Like, we'd rather have the mortgage bonds and an extra 150 to 200 basis points of yield in exchange for that risk. Now it's kind of higher, but it feels like that. Historically, it has always been, Rob, 150 to 200 basis points the spread, right?
I don't know what the historic level is, but I'm glad you brought up the fact that mortgage rates are higher than treasury rates, because I'm asked that like a couple times a week, like, why? And the basic reason is the prepayment risk that might happen. The borrower pays their loan off and refinances, or the borrower defaults. And I would say that both of those things, the risk right now are pretty small. When you talk to any underwriter or loan officer, the pool of mortgages that are out there now, the however many trillion that are outstanding, with all the ability to repay and so forth, the credit risk is arguably the lowest it's ever been. And then the prepayment risk, it's pretty minimal. We're not going to go back to a 3% 30-year fixed. We could see prepayments, of course, picking up because people are refinancing to pay off their 29% credit card debt. But I don't mind, if I'm a money manager or an insurance company, pension fund, whoever, I don't mind taking a little bit of prepayment or credit risk and buying mortgage-backed securities that are out there, because I'd say it's a good bet. And it's interesting. I think that we will see, when Rich, you mentioned the average mortgage kind of stays on the book 7 or 8 years. Well, we're already 5 years into a lot of people getting 3% loans, right? And so I think this current batch is going to stay on the books, is going to extend that 7 or 8 year horizon to 10 or 12 years possibly.
a great point.
Yeah.
And yeah, very likely. So the lenders, your trials and tribs around the industry, the lenders on like the tech, automation, customer experience side, like the ones that are getting it right, that are ahead of the curve, that are, picking up LOs and market share right now. What are the elements, the consistencies you're seeing, amongst the best and brightest and most forward-thinking lenders that you're interacting with right now in this
Yeah,
market?
a couple things. I mean, one thing that I believe is true is that the best out there are paying attention to their employees as well as the customer experience. I mean, it's said that your customer experience is never going to be any better than your employee experiences. That's what caps you. So I think there's a lot of good lenders out there really paying attention to their employees. I mean, let's face it, this is a tough market and it's been a tough market. I mean, it's a grind. And so I think they're really paying attention to their teams, even as they're going through changes that they need to make. But again, I think it's the folks that are, as they are being wise in terms of evaluating their tech stack and really thinking about how all these things are playing together, are making really smart decisions about what is going to support their loan officers, not, necessarily replace them, right? Because I having been a loan officer for a long time, people are people, and where going through a purchase, it's a human interaction where a human, I still will always believe a human will always need to be involved when there's a human on the other side of it. But I think there's the best lenders that I'm seeing are leaning into shoring up their technologies, utilizing data, I think in ever better ways. Again, there's a world of data out there that lenders have currently, or if they don't have it, there's ways to get it now that are much more cost effective than a few years ago. And then applying insights to that and then taking action and just, setting up their team for success. So I think those are the building blocks that I see. Again, paying attention to their team. There's a lot of evaluation, reevaluation, as I said, of the tech stack, clearing out the things that are the shiny objects. And I think some of the best are also really partnering with their technology providers to find out how to use something better. What are the best practices? Are we using this in the best way? How can we use it better? I think sometimes lenders feel like they're on their own. And I always have encouraged, I wrote an article called Couples Therapy, and it was about,
Yeah.
lenders and tech companies coming together because, ultimately we all want to be able to serve the consumer and help them in home ownership and have great, successful businesses. But there needs to be a little bit more dialogue instead of some of the standoffs that happen. So, but that's where I'm seeing people are really succeeding, and and I'm an eternal optimist. So as I'm listening to you talk about some of the things coming up with rates and the market, my hope is that the spring market is just perhaps running a little late this year, and it'll,
It's going to work out. I think
Yeah.
the biggest thing that is happening is getting some clarity. Fiscal policy doesn't make a difference whether you like who's running the country or not. At the end of the day, if you're a CFO, a business leader, you just need line of sight, good or bad. Like, what are taxes? What are regulations? And animal spirits get lifted, right? So I'm really, really optimistic about, every time we see a downtick in rates, they're like ants. They come out and let's do something. So I see
Really.
it coming back.
It is true. Every time we see a downtick, I mean, you just look at the app stats. I mean, heaven forbid we were to get down to 6.3 or 6.4 that we've touched a couple times. I mean, I think right now it would unleash a lot of new volume. Heaven forbid, a little lower than that. But
Oh boy. Well, that's from going from 2 to 8, people said we need it in the 5s. We don't need it in the 5s. You just need stable low 6s, and life will really carry on.
Yep. And
Agreed.
to that end, Bill, I would argue right now, like if you're a loan originator, that is just communicating on a regular basis with your database, just having a handle on, the rate climate and the rate market right now and numbers coming up. And like, to me, trusted advisor to your clients, want to be clients. I would argue that is important as ever right now with, things are very rate sensitive right now. You get the 7% people that could be looking at refis, hopefully at some point. And you got a lot of these people that are, between 2.25% and 3% that would love to move, but maybe can't stomach, going to 7, but, hey, maybe it's 6, So, I mean, what advice would you give to those people? I know at Tabrasa, you guys are doing a lot there to help educate originators and clients, but I would just love your thoughts on how people should navigate that these next several months.
Well, I think, that simple chart, right? That's a story, and you always have a story to tell, and they always point back to you, right? And so this is what's happening now. I'm going to let you know when these things break. And then there's tools that we have, like you monitor to home and home values and equity to get that early top of the funnel stuff. But just talking about from a rate standpoint, I don't think the media does a great job historically of ever sharing good news. And certainly as it relates to rates. I mean, by the time these little refi booms pop up, Fannie Mae's reporting it a week later and it's already dried up and gone. And so you have to tell the partners every Friday. You have to tell everybody in your database just rate updates. And then when this dam breaks, because we're going to break through this, when it breaks, it'll already be late for a lot of people. I think it's going to create such a flurry of activity. You've got to almost continue sharing the story, continue saying, okay, now we have some good news. We got fiscal policy clear. Now we're watching debt. We're watching this, so many things. It isn't just if the Fed lowers rates, things are going to get better. If anything, it may muck it up. And so, there's just a lot to track. And I think, obviously at Mortgage Market, I think we do a great job because you have to bring it down to a fifth grade level. You have to understand it deeply enough to where you can articulate it to where, like, my mom would understand this. When she asked me, what do you do, Bill? So you got to make it really easy. But, watch key levels and follow the news.
And
It's not that hard.
you always have a fresh story to tell too. That's the thing that I have always loved about Mortgage Market Guide is that you've always got something to talk about, something new to talk about, a new story, something to help people, understand, become more educated, and position yourself as the expert. So it's good stuff, Billy.
Cool. Sue, the latest and greatest at Ingenious, great data provider company for the mortgage industry. A lot of lenders are successfully leveraging for a lot of different ways to grow their.
Oh my gosh.
Yeah.
It's super exciting. And in fact, I don't even know if I'm supposed to talk about this yet, but I don't think it's a secret. But we've actually got Ingenious 2.0 coming out in the next couple of months, which is going to be really cool up level in terms of, speed, look, feel, some of the functionality, some new things coming down the pipe. So that's very exciting. And one of the big things too is, people rebuilding databases. This is a time where people are moving around companies and, with all of the litigation that can happen around a database, having the ability to rebuild your database because there's all the transaction data that's there, have all the contact information there. You can help your real estate agents who probably don't do a great job of building a database. You can rebuild their database.
I love that story. That's a cool story.
It's awesome. I mean, people just, and just from a leadership level too, being able to kind of see, what's happening out there in the market in terms of where are people gravitating to, where are they going, out of, how does that, there's just, like I said, there's so much interesting data out there to be able to apply to the business. And so it's been an exciting time to connect up with the Ingenious gang and keep us rolling towards Ingenious 2.0.
Love it. Seems like, perfect match of organization and individual. And congrats on all the success there. So
thank you.
Good stuff. Well, as always, the time rapidly flies by here on the Big Picture, presented again by our friends at Depth. And I want to thank Sue and Bill for joining us this afternoon and such a spirited and insightful conversation. Thank you, guys.
Thank you.
Thanks. See you, everybody.
I saw that, Sue. I saw you typing.
Did you see? I was trying to really be beneath the screen here, but.
And as always, thanks to all of you for tuning in with us this week. We do the show live for those of you listening to the pod or watching on YouTube. We do the show live on Zoom every Thursday at 3 Eastern. You can go to chrismancommentary.com to get signed up. And Rob, and what's in your world? Any upcoming travels? Anything of note in the Chrisdom world coming up here in July?
Yeah, quite a bit. I'll fill you in next week's show.
Okay, all right. So
he's laying low right now. He's going to hang out at the
like the soap opera, like
the movie van shows up tomorrow, man.
Well, good stuff. Thank you guys for sharing part of your Thursday afternoon with us. And next week, Bob Brokesmith we have on. And we're starting a half hour earlier next week, too, to accommodate Bob's schedule. So we'll go live at 2:30 p.m. Eastern. But we'll be good, as always, to get caught up with Bob. Even though he's a Cubs fan, we still will enjoy that. So, well, thank you guys very much. And have a great rest of the week and weekend. We'll see you next week. Take care.
Thanks, everyone.
Bye-bye.